I'm Bill Woodruff. I'm the founder, chief investment officer at WealthFactor. Today I'm going to share some thoughts about stocks or individual securities and their benefits and disadvantages versus funds like mutual funds or ETFs. So let's just go through some of the examples I have up here for the pros and cons associated with funds. So diversification is absolutely a pro and very positive thing from a fund perspective. Low transaction costs through scale, absolutely true. If you looked at some of the largest ETFs and the annual dollars they spend on trading costs, it's incredible how low they are. Improved execution costs through scale. I'm going to caveat this. In general, this is true. With scale, you have the ability to trade and have execution. The challenge that you see, though, in the counterpoint to this is scale becomes a challenge for smaller securities. And this is one, I think, often overlooked area in financial markets for smaller companies. And the reason why you see the prevalence in passive investing for market cap weighting. If you look at Vanguard with 5.6 trillion in assets, they really can't do anything other than market cap weighting. Easy access to foreign markets. This is true and remains mostly true. On a relative basis, it's far easier to access foreign markets directly with individual securities than it's ever been. However, there's all sorts of additional considerations, exchange and currency, that perhaps make it not worth it relative to especially some of the lower cost ETFs when building foreign markets exposure. Access to investing in smaller amounts. This is still true, but I'm going to put a line through this because the definition for smaller amounts is rapidly approaching a much more palatable number across lots of investor types. And I would put building a 300 to 500 security portfolio of individual stocks feasible and rational from an expense and time and energy perspective down to as little as $300,000 to $500,000 portfolio size, where 10 years ago it was probably 10 million and 20 years ago it was probably 50 million. And so again, technological innovation is quickly changing these things. Accountability and fairness to investors. This is something that is and continues to be something that's a strength of funds, right? You have a single fund, every investor gets the exact same experience. So what are some of the disadvantages to funds? An added layer of fees and expenses. There's no potential for customization, execution control. So this is maybe there's some differences in types of funds, right? Whereas a mutual fund, you execute at the end of day based on end of day pricing for all the securities within that fund. An ETF, an exchange traded fund, clearly has more execution control than that. And then tax inefficiency. In many cases, your taxes are influenced by rules and regulations associated with the required distributions or other investors' decisions or manager decisions to buy or sell securities on your behalf, which may or may not be really in your best interest as an investor. So let's look at individual securities or stocks. We'll dive right in to the pros. Tax efficiency is probably the biggest one. If you have one fund that has 500 securities, you have one tax decision. You either sell it or you don't sell it. If you have 500 individual securities, you now have 500 individual tax decisions. And based on maybe some deviation in your tax situation each year, or simply just an intentional tax loss harvesting strategy annually to maximize the reduction, maximize the amount of capital gains, or potentially increase capital losses for the purposes of reducing tax liability, each investor, should you use individual securities, now has more control of the tax outcomes. Portfolio customization, certainly true. However, many of the benefits that you get, or many of the things that diversification and those sorts of things are really index-based. And so the customization is limited, consistent with my risk smart approach to investing. It's a pure avoidance of picking, timing, and then effectively layers. Execution control is obviously very, very high, more accessible thanks to low trading costs. And so I referenced this already with commissions as low as they've become, down to maybe as little as $300,000 in terms of the size of portfolio where building and using individual securities starts to make sense. Full transparency. So if you own a fund, you have a layer between you and what you own. Whereas if you own these securities in your name directly, you may not necessarily want all of this information, but it's there. Those are your securities. And so that extra layer from both the transparency and all other aspects isn't there. And then same thing with fee efficient. While many ETFs especially are approaching, and in some cases, the most broad and simple index-based ETFs have actually become free from a fee perspective. There's no potential layer of a fee from a fund. Some of the cons are still, or some of the cons associated with building portfolios of individual securities: access to investing in smaller amounts, as well as access to foreign markets. These two are somewhat linked in that, I've kind of continued to say, access to smaller amounts, we're seeing that the removal of that over time, thanks to technology and lower trading costs. That remains true with foreign markets, where it's hard to justify using individual securities because of the additional complexities when using foreign markets. And so investors should continue to focus on aspects in their portfolio that can drive efficiencies, minimizing fees, creating simple portfolio structures that are efficient, and then to increase tax efficiency. Hope you found these comments useful. Stay tuned for further insights. Thanks.